The world runs on oil. It is the lifeblood of modern economies, powering our cars, factories, homes. This global system depends on the steady flow of millions of barrels every single day. Most of this oil travels through a few critical maritime choke points. The most important of these is the Strait of Hormuz. When this vital artery was severed in early March 2026, the global economy felt the shock almost instantly. The International Energy Agency called it the greatest global energy and food security challenge in history. About 20% of global oil consumption passes through Hormuz, closing its stranded supply on an unprecedented scale. Kuwait, Iraq, Saudi Arabia, and the UAE saw a collective drop of roughly 6.7 million barrels per day within days, climbing to at least 10 million barrels per day soon after. Markets reacted instantly, pricing a deep and immediate deficit. Brent crude surged past $120 a barrel, a spike of roughly 55% from pre-war levels. Why did a 20% supply cut translate into an 80% scale price shock? Because the physical world of barrels collides with the paper world of futures, and the paper market amplifies everything. The 2026 Iran war created a crisis unlike sanctions-driven shocks. This was a physical disruption. A closed choke point doesn't just make trade illegal, it makes exports physically impossible. Oil is not a file you reroute with a click. It's a heavy liquid moved by massive tankers along narrow, specific routes. When Hormuz blocks, the entire logistics chain seizes up. Alternatives exist, but lack capacity to backfill millions of daily barrels. As tankers couldn't sail, oil had nowhere to go. Onshore storage filled fast, forcing a brutal choice: shut in production or risk environmental and operational disaster. Force majeure declarations made it plain: deliveries could not be fulfilled. This wasn't a voluntary cut. Infrastructure was paralyzed. Shutting and restarting wells is complex and risky. Reservoir pressures can shift, slowing any rebound. Markets priced not only barrels lost today, but delays tomorrow. A physical choke point created a deep deficit that paper markets would magnify into dramatic price action. The world looks to spare capacity. The quick start barrels within 30 to 90 days. Years of underinvestment and disciplined OPEC Plus cuts thinned that cushion. Most spare capacity sat in Saudi Arabia, some in the UAE, right behind the blocked strait. Even if they pumped more, their primary routes were shut. OPEC Plus agreed to resume hikes at a slightly faster pace. They added just 206,000 barrels per day in April. Against a 10 million BPD outage, that was a drop in the ocean. Analysts noted almost all producers were effectively maxed out. With no cavalry coming, prices had to do the heavy lifting. Buyers bid aggressively for any available barrels. Prices must rise to incentivize higher cost supply, or, more immediately, force demand destruction. With little spare capacity, the adjustment would be sharp and painful. Strategic reserves exist for moments like this. Shock absorbers, not brakes. Coordinated releases can calm panic, but they cannot replace a sustained 10 million BPD loss indefinitely. The administration, with IEA partners, announced a major collective release: 400 million barrels from strategic reserves. The U.S. initiated an 86 million barrel first tranche, part of a 172 million barrel U.S. exchange. The SPR held about 415 million barrels at the time. Prices eased, temporarily. Moving crude from caverns to pumps takes time and coordination. Drawdowns shrink the safety buffer for future crises. The SPR can soften the blow, not lift a blockade. Then came a 30-day sanctions waiver for Iranian oil already at sea. Officials said it could add about 140 million barrels to supply, aimed to cap prices for 10 to 14 days by easing the risk premium. But legal and reputational frictions kept the impact measured. Helpful at the margins, insufficient while the choke point stayed shut. For every physical barrel, many paper barrels trade on NYMEX and ICE. Futures are binding agreements to buy or sell at a preset price and date. They hedge producers and consumers, and attract massive speculative capital. In crisis, traders price not just today's loss, but tomorrow's risks. That anxiety adds a premium, often tens of dollars per barrel. Futures jump, physical sellers lift offers, futures jump again. Prices on screens move faster than actual oil can. That's how a 20% physical cut morphs into a 55% or larger price surge. One episode crystallized the stakes, a suspected $580 million bet. 15 minutes before a de-escalation statement, futures were sold, big, betting prices would fall. The statement landed. Prices slipped as risk receded, profit captured. The timing fueled calls for an insider trading probe. Conversely, any hint of escalation triggered buy waves. Speculative inflows act like an accelerator pedal. Thousands of small bets add up to big moves. The market priced shortage and fear and the lure of profit. In turmoil, paper markets don't just reflect reality, they shape it. That is the amplifier that turned a choke point into a worldwide price explosion. The spike wasn't abstract, it hit wallets immediately. Crude is the largest determinant of gasoline prices. Higher crude rippled through refineries, terminals, and pumps. U.S. averages jumped to $3.98, a 33% surge in a month. California blasted past $5 per gallon. Analysts warned of another 10-30 cents, with bigger jumps at some stations. Diesel spiked, lifting freight costs from food to electronics. Higher fuel acts like a tax, straining homes and businesses. Prices rise at the pump quickly and fall slowly. The pass-through is asymmetric. The shock moves from tankers to Main Street in days. At the heart of oil's volatility is inelasticity. In the short run, supply is rigid and so is demand. New barrels take months or years. Consumers can't quickly cut essential use. So small physical losses cause outsized price spikes. A choke point shifts supply sharply. Prices skyrocket to ration demand. Only very high prices nudge behavior enough to balance. March 2026 was a cascade of causes. A physical outage near 20% hit a system with thin resilience. Producers couldn't fill the gap. Futures amplified the shock far beyond the physical loss. Government moves bought time, but not a solution. The single most important variable? The status of the Strait of Hormuz. A credible, lasting reopening would bring barrels back and prices down. Prolonged closure or escalation keeps prices elevated. Watch SPR cadence and any non-Gulf additions, though limited. Expect sustained high energy costs to strain budgets and margins. Nations will seek more secure sources and routes, and invest in renewables and efficiency to reduce exposure.